Today, UK home prices resume their falls. Hello again, it's Martin North from Digital Finance Analytics, Web latest post covering finance and property news. Well, news on the UK property front is showing further declines. In fact, UK prices resume their decline, with Nationwide Building Society warning that headwinds for property sellers are increasing. The mortgage lenders' measure showed prices fell 0.1% in May after a 0.4% gain in the month before, a figure that was revised lower from the previous estimate. The annual pace of declines reached 3.4%, which is the sharpest since 2009. Borrowers are facing a sharp jump in mortgage costs after inflation remained higher than expected, prompting investors to bet the Bank of England will keep raising interest rates through this summer. Headwinds to the housing market look set to strengthen in the near term, Robert Gardner, chief economist at Nationwide, said in a statement on Thursday. Rates are also projected to remain higher for longer. If maintained, this is likely to exert renewed upward pressure on mortgage rates, which have been trending down. He projected a relatively soft landing for prices because unemployment remains low and households have built up a financial cushion to weather the shock. The annual pace of declines accelerated to 3.4% from 2.7%, putting the average value of a home at £260,736, or about 4% below its peak in August last year. Separate figures from the Bank of England showed mortgage approvals fell and consumers repaid debts at an historic pace, reflecting a jump in interest rates. Lenders authorised 48,700 home loans in April, down sharply from the 51,500 approved in March. The effective rate on new mortgages rose 5 basis points to 4.46 in April, closing in on the threshold of 5% the Bank of England has defined as being painful to consumers. The Bank of England figures showed households repaid £1.4 billion worth of mortgage debt in April. That's the weakest month on record, excluding the pandemic. So it does seem that Britain's housing markets are set for a further correction. While the index declined by less than expected in May, lenders have started to pull back cheap mortgage deals from the market in anticipation of higher borrowing costs. This means a more significant adjustment in house prices likely to resume. Indeed, the credit rating agency Moody's predicted the UK would tip into a mild recession because of rising rates. Despite the slip in national prices, estate agents said demand in London, where prices are most expensive, does remain high. May saw a lot of activity in central London, with international buyers, in particular high net worths from the Middle East, coming to the capital in big numbers to take advantage of the recent softening of the market and invest here securely for the long term, said Oliver Fish, director of London-based luxury estate agency Oliver James. Landlords, meanwhile, have been forced to sell some of their property portfolio as mortgage costs rise. But Fish expects confidence to creep back into the market during the course of the year as we adapt to an even more expensive rate environment. Despite the quickest series of rate rises in 4 decades, the impact of rising borrowing costs is only just starting to hit the housing market. The Bank of England estimates that only a third of its rate hikes since December 21, which has pushed the base rate from 0.1% to 4.5%, have already hit through the economy. Borrowers feel the impact when they go to refinance fixed rate deals, with the Bank of England estimating 1.3 million face that pain between April and December this year. For several months, Nationwide's measure of house prices has shown sharper declines than rival lender Halifax. Even so, Halifax's index fell for the first time this year last month, underlining the downward pressure hitting the market. Despite the decline, house prices have not fallen by the 10%, which most economists warned of this year, while tighter financial conditions have subdued buying activity. A lack of supply and a robust labour market have meant the market is holding up better than expected. And of course, migration is also stronger than expected as well. And talking about migration, it's worth noting that net migration to the UK has driven property rental costs up by as much as 7%. And that indeed could be behind the manic market facing tenants in London, according to economists at Capital Economics. Forecasters at the consultancy warn that growth in rent costs will remain historically high, even if UK net migration eases from the record surge last year. A record 606,000 more people migrated to the UK last year than departed, adding to strains on public services of all kinds, and rents are already rising at a record pace, with London's market particularly frantic. And it's worth noting that whether you are renting or paying a mortgage, Capital Economics now thinks that the average payment is more than £1,000 a month, which is remarkably high and putting a lot of pressure on a lot of households. Net migration is likely to ease due to a surge in student arrivals reversing and fewer people coming from Ukraine. That may reduce some of the pressure on Prime Minister Rishi Sunak to make good on his promise to reduce the inward flow. Immigration won't be as high this year, adding to the reasons to think that rental growth has peaked, said Imogen Patterson, economist at Capital Economics. But strong pay growth, high mortgage rates, and some Ukrainians seeking their own homes means it will remain high by past standards. And she said that immigration may have increased rents by 3 to 7% when looking at the historical relationship between rents and the share of homes that are empty. And Patterson added the impact may be particularly strong in the capital since incoming immigrants tend to initially live in London. Average private rental prices climbed by 4.8% year over year in April in England, and that's the biggest increase since records began in 2006. However, survey data suggests those agreeing new rental deals are suffering even bigger rises, which again mirrors what's going on in Australia. So there are some interesting parallels between what's happening in the UK and Australia, and it may well be that we will see more falls here in the UK as those interest rate rises continue to bite and as fixed rate mortgages reset. It's a similar story, unfortunately. Same old, same old. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.